Early morning in the USA, Trump truth this hour on Truth Social. The Democrats shutdown cost the USA at least 2 points of GDP. That's what they are doing. In mini form, again, no shutdowns. Also, lower interest rates too late, too powerful is the worst. And come to find out several hours later, it was essentially a leak regarding how the US economy is doing. Because what the Financial Times and the Bureau of Economic Analysis subsequently reported was devastating. But the US managed to achieve an abysmal 1.4% GDP growth in the fourth quarter of 2025, far, far below the 2.8% that economists in the Bloomberg poll had expected. And if you go back to just a few weeks ago, the Atlanta Fed GDP Now model was predicting growth as high as 5.4%. So what happened? Well, we'll be discussing with what happened, how the economy was performing that led to this figure and what we could expect in the future. And finally, what does this mean with the AI bubble? Okay, so now that we've discussed what we are going to be going over, what happened, well, there were three major factors that collided to provide this abysmal 1.4% figure, and you have to understand each one of these to see the full picture. First and most significantly, the government shutdown. The government was shut down for around 43 days, causing this massive funding gap that ran out from October the 1st to November the 12th, 2025. It was the longest government shutdown in American history. And when the government shuts down, it doesn't just mean that federal workers stay at home. It means contract gets frozen, procurement stops, government services grind to a halt, and all the activity that would normally contribute to GDP simply doesn't happen. The Bureau of Economic Analysis estimated that the shutdown alone knocked approximately 1 percentage point of the fourth quarter growth. The Federal Reserve made the same projection back in December. The Congressional Budget Office went even further, estimating that a 6-week shutdown would reduce quarterly growth by 1.15 percentage points. So when Trump said that the shutdown cost at least 2 points, he's exaggerating, but the real number of around 1 percentage point is still devastating when you're already expecting modest growth. Second, the trade deficit exploded. On Thursday, and just one day before the GDP release, data showed the US trade deficit widened to 32.6% in December to $70.3 billion. That was far above the $55.5 billion forecasted. And for the full year of 2025, the goods trade deficit hit an all-time record high of $1.24 trillion. Remember, imports subtracts from GDP while exports add to it. When your trade deficit widens that dramatically, it drags down your headline growth numbers. Despite all the tariffs, the deficit barely moved from 2024's level. And finally, the consumer spending slowed. Personal consumption expenditure, which typically is around 70% of the GDP, rose just 2.4% in the fourth quarter, down from 3.5% in the third quarter. That's a significant deceleration. Consumers were still spending, but the momentum was fading. Higher prices, elevated interest rates, and a weakening labor market was starting to bite. And here's the kicker. All of this were happening while inflation was actually accelerating. The PCE index rose 2.9% in December, and core PCE hit 3%, so you had weak growth and sticky inflation at the same time. A signal for early stages of stagflation. To understand how we ended up here, you have to look what the economy was doing throughout 2025 because the warning signs were already there. The year started poorly. In Q1 2025, the economy contracted because of a massive pre-tariff surge in imports. Companies were stockpiling goods before Trump's tariff kicked in, and that front-loading created a temporary drag on GDP. But then came the rebound. Q2 delivered 3% growth. Third quarter was even stronger at 4.4%. Consumer spending was resilient, business investment was booming, and AI-related capital expenditure was providing a significant tailwind. But beneath those headline numbers, cracks were forming. The labor market was deteriorating throughout the year. US employer added 584,000 jobs in all of 2025, down from over 2 million in 2024 and the weakest year for job creation since 2020. The unemployment rate drifted up to 4.4% by December, the highest level in 4 years. Hiring rates were normalizing, but they were normalizing downwards. And as one economist put it, 97% of net private sector job creation in 2025 was in healthcare and social assistance. Inflation, meanwhile, refused to cooperate. The consumer price index started the year at 3% and stayed stubbornly elevated. Despite a Fed rate cutting 3 times in the latter part of the year, the core inflation remained a full percentage point above the Fed's 2% target. The tariffs added roughly half a percentage point to inflation, according to Oxford Economics. Consumer sentiment was also weak. Polling showed the majority of Americans were living a paycheck to paycheck. The economy became increasingly K-shaped. Wealthy consumers, excited by record stock market gains and AI enthusiasm, kept spending robustly, while lower and middle class income households pulled back under the strain of elevated prices and high borrowing costs. And then the shutdown hit right at the start of the fourth quarter, when momentum was already slow. The shutdown disrupted data collection, delayed government payment, froze federal contracts, and created uncertainty across the economy. By the time it ended mid-November, the damage was already done. The economy that had looked so strong in the third quarter was now limping into year-end. The 1.4% figure wasn't a surprise to those who were paying attention. It was the inevitable result of compounding weakness finally showing up in the headline number. So what can we expect going forward? Well, in my view, it's now obvious that the Fed will have to cut rates, and not just one or two cuts. They'll need to move aggressively than they've been signaling. Look at the data. You've got 1.4% GDP growth, which is well below the trend. You've got a job creation at its weakest since the pandemic. You've got consumer spending decelerating. And while inflation is sticky, it's not accelerating out of control. It's elevated but stable. The Fed has a room to act. Most analysts expect a bounce back in the first quarter of 2026 as government spending normalizes after the shutdown. The Congressional Budget Office projected that whatever was lost in the fourth quarter would largely be recovered in the first quarter, but that's just a statistical rebound. It doesn't address the underlying weakness in the labor market or the strain on consumers.